Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day. And we have a great one today from Dan. Hi Alan, I recently sold an in-the-money covered call on Delta Airlines, ticker DAL. The stock has a dividend in which the ex-dividend date was May 7th. On May 6th, the option was still in the money. The owner of the call decided to exercise it early for the dividend, which for me was perfect. I received the full premium for the call, and on top of that, my capital was freed up to sell yet another call on another company. On the downside, of course, I did not receive the dividend, but the dividend was minimal anyway. My question is this: do some people use this strategy of selling in-the-money calls on companies with dividends in hope of an early execution? Seems like a viable idea for a strategy. Well, Dan, well done. This is a great question, and I'm so happy that you thought of it. So let's start off by just reminding everybody of the strategy that you're suggesting in your question, and then we'll evaluate it and see whether this is something that we should adopt. Okay, so in Dan's proposed strategy, we're going to sell an in-the-money call when a stock has an ex-dividend date prior to expiration Friday. An ex-dividend date, as most of you know, is the date you must own the shares in order to capture the dividend. Now, the option holder exercises these shares and buys our shares from us in order to capture that dividend. So that frees up the cash for us to then generate a second income stream in the same month with the same cash. All right, so you were using Delta Airlines, ticker DAL. Let's have a look at the dividend information as we would look at it in determining the ex-date and the amount of the dividend. So here's a screenshot of the information that I was able to access. And as you could see, the ex-date was May 7th, as you did state in your question. And a little further down where it says dividend amount is 6 cents per share or $6 per contract. So it's not an overwhelming amount of money that you're going to capture from that dividend. But in any case, that situation. So the next question is whether or not this is a viable strategy that we should all get involved with. So let's have a look and evaluate this strategy now. Well, the strategy will generally work when the dividend is actually greater than the time value remaining on the option. Now, what I mean by that is if the option holder knows what he's doing or she's doing, if the time value remaining on the option is greater than the dividend, then the option should be sold to capture more money. For example, if you've sold a $30 strike and the price of the stock is currently $32, leaving the strike $2 in the money, and the premium on that particular option is $2.10, and let's assume for a moment that the dividend is 50 cents, well, the time value on that premium is 10 cents. The dividend is 50 cents. That's a situation when the holder might exercise early to capture that 50-cent dividend. He'll capture $2 of intrinsic value on the option side and another 50 cents on the dividend side. Now, if that dividend was like DAL, 6 cents, and the time value was 10 cents, well, then it would pay just to sell the option. So for this strategy to work, the dividend has to be greater than the time value remaining on that option. Now, here's why the strategy may not work universally. The pool of stocks that have the particular specifics that you're talking about, Dan, is very limited. First of all, it would have to be a stock with a dividend, and the ex-date would have to be prior to expiration of that particular contract. So when you're selecting your stocks for that strategy, the pool of eligible stocks would be much smaller than our current pool. And you're also limiting yourself to in-the-money strikes. Those are the ones most likely for early exercise. But if it's a bull market and the chart technicals are all bullish, we should really take advantage of that out-of-the-money strike. So here we're restricting ourselves only to in-the-money strikes. That's something that I don't like in many market conditions, particularly bull market conditions, and to tell you the truth, even in neutral or normal market conditions. Furthermore, you're depending on retail investors to know what's going on here. You're depending on them to exercise early when it's appropriate. Many retail investors, probably most retail investors, don't understand the relationship between the time value of the option premium and the amount of dividend that's about to be distributed. So what I'm saying here is that many retail investors don't know to do this, may not exercise early, or on the other hand, they may exercise early inappropriately. In other words, spend $1 to make 50 cents. Now, in the case of Delta Airlines, as we said before, the time value would have to be less than 6 cents in order for this to make sense. I don't know what it was at the time of exercise, but there's a good chance that the holder of the option inappropriately exercised early in this particular case. So, Dan, there's a lot of things about the strategy to be used universally that I don't like, particularly restricting yourself just to the in-the-money strikes and depending on the retail investors to know exactly what they're doing as it relates to the time value of the premium and the dividend. So there are a lot of things I don't like about it, but I have to tell you, I'm very impressed that you did ask the question, because it is very similar to that mid-contract unwind exit strategy theory that I have in my third book, The Complete Encyclopedia for Covered Call Writing, where you actually generate a second income stream in the same month with the same cash. So when it comes up, take advantage of it, but I would not use it regularly as my sole strategy as it relates to covered call writing. But kudos to you, Dan, for asking that question. And thanks to everybody out there for watching this video. Hope you enjoyed it, and I hope you found it useful. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.